Hi, it's Anthony Fletcher. Thanks for coming to my channel. Today, I thought that I would talk a little bit about the difference between buying a house and renting them. Which one is going to be better for you? And so, what I did here is I kind of put together a scenario based off two different properties, both within a smaller city next to Portland, Oregon, by the name of Troutdale, Oregon. And both of these houses are going to be 3 bedroom, 2 baths, and they're very similar in size and actually just about 2 blocks from one another. And so, what I thought I would do is I show you kind of how much difference it would be in the benefit of buying if you plan on going to be holding on to a property for a long period of time versus renting year after year after year. One of the things that I see a lot of times with people that have been renting homes for years and years is that, well, they don't have enough money down the road in order to actually purchase a home. Mainly the reason why is because the cost of the rent has gone up and up and up, more like 10, 12. In fact, in Oregon, they can go as much as 17% this year. And rather than being able to keep up with that, they continue to pay that monthly rent because it's easier for them to succeed in making that payment. Unfortunately, as they continue to have children and buy other things and have other expenses through life, it gets further and further away from them that ability to buy that house. So I want to kind of show you the importance of, if you have the opportunity and you're thinking about purchasing a home, how much beneficial it will be for you in the long term. As it's shown that from a book that I read about 10 years ago, it basically said that the average person that didn't own a home basically had assets around $4,000. The average person that owns a home has assets of about $186,000. So I think this might show you why the benefits of buying a home. However, like I said, it may not be specifically for you, but let's check this situation out and go through it and see if it's going to be workable for you. Okay, so we've got two homes here. The first home is a rental property here. And as you can see, this rental property here, it is about 1,300 square feet, and it's going to actually rent for 2,400 a month. But for our purposes, we're going to start with the use of $2,000. Okay, versus a property that you can buy. And this particular property is 2 blocks away, and it's basically the same size, and it goes for about $369,000. And the seller, the builder, is willing to give you $6,000 towards your closing costs. So that in essence makes like a $375,000 house. And the builder is going to give you $6,000 towards your closing. So we're going to compare these two up on my board right behind us, and we'll get started with this now. So let's look at what we've got. So the buy versus the rent. So the buy, we've got a $375,000 purchase price with a 6% mortgage rate, 5% down, and this is assuming that appreciation of the home is going to go up by 4% per year. It also says the appreciation of the rent is going to go up by 4% per year. Now, also, there's something else that we need to talk about. If you're going to get into the home and leave the home, let's say in whatever year, let's say year one or whatever, you're going to have the cost of selling the house. So that's going to be about 5%. And we'll show you that figure in just a second. Plus, there'll be some other closing costs. So let's look at this for the first year. After the first year, you purchased this house, and you're going to pay roughly $26,631 in mortgage payments. So if you look at that rate, it's about $2,300 per month. Okay, and versus $24,000 in payments for the rent. Now, of that 26,000, you're going to have 4,300 that's going to be principal. So that's going to be paying the property value, the property down as far as your balance down. But you'll also have property taxes to pay of roughly $3,700, insurance $600, homeowners insurance. That property had homeowners insurance of $1,200. Now, if you did want to sell that house, you would have a selling commissions of about $19,000, and then closing costs of $2,000. And over here, you put a down payment on this side. So if you would have left the down payment over here, you probably would have made about $562 in interest if you left it in the bank. But also, there's two things that you don't normally see, and one is you have tax savings. So when you go and you do your taxes at the end of every year, now you fall into a different type of tax bracket usually. And with that, you have more deductions. And by doing that, you can write off about $3,751 off of your, it benefits you by $3,751. And how that is because if you pay roughly about $20,000 in interest over the course of the year, you get to write that off of your total income, and it makes you look like that you made less income. Therefore, you pay less in taxes, and that's what that number is for. And then appreciation, the property will probably, like we said, go up by 4%, so that's $15,000. So at the end of year one, you can see that net is costing you about $28,113 to buy the house, where it's only costing you $23,900 to rent a property. Plus, if anything goes wrong, then the landlord is supposed to take care of it. Now, the good news is on a brand new home like that, there's usually a 1-year warranty. So one, you probably shouldn't have any issues there, but also with the 1-year warranty, the builder should take care of any issues that there are. Now, year two, when you look at it, it now changes. We now have $36,000 in there, and the total cost over for renting is now $48,000. And mainly it's because what we've got is the same payment schedule here, but the difference is there's more appreciation and there's more tax savings and more money going towards the principal. In year three, if you were to sell the house in year three, it would have cost you $48,219. Year three as a rental, it'll cost you $74,680. Okay, so it's making quite a big difference. Now let's jump to year five. In year five, it's going to cost you $61,140 to own a house, or it'll cost you $129,000 in amount of money that it costs to rent. Now, part of the reason, like we talked about in this case, by year five, you have $81,000 in appreciation. And like I said, I only use 4%. And of course, in Oregon, for example, like a lot of other states, we had appreciation at 10, 15, and 20%. So this is very low. And then the taxable savings is $18,000. So it saved you $18,000 off your taxes. Now let's really get into a big number. Let's say you're going to keep this house for 10 years. So 10 years, your total cost of owning this house is $76,196. So sure, must have made those payments, but the thing about it is you've had over $180,000 in appreciation to offset your mortgage payments. Whereas if you rent, it's going to cost you $286,698. So if you look at that number over the course of 10 years, the person that purchased the house is going to have about over $200,000 more in wealth than the person that did rent. So you can see that this is quite a big difference of a change. And the problem is that once you get stuck into a rental property, it's quite easy to make this payment. It's also quite easy to have the landlord come and talk to you and help you out if there's issues with the house, if there's broken pipes or whatever. But the key thing is if you buy a newer home or a home that's in really good shape, then you shouldn't have to do any sort of improvements for 10 years because everything should keep in good shape. So there you go. There's the reason why you should buy versus rent. Thanks again for showing up on my channel. I sure appreciate it. Please like and subscribe, and we'll see you again in my next video. Bye now.